Physician on Fire's tax return. This is the 39.6 Facebook Live and YouTube Live Finance Show, where we talk about general investing, taxes, real estate, syndications, Airbnb, paying for college, childcare, and even the car you drive. Today, we are talking about Physician on Fire's 2019 tax return. We are going to do a whole bunch of talks on taxes. We still haven't filed ours yet. Our personal return, our business return went out a month ago, but we still have about 2.5 more weeks for the personal return. We're waiting on one more thing. Hopefully it comes soon so we can file our taxes. I don't think we'll be going through our 1040 though. Maybe parts of it. Okay, so Physician on Fire dropped a huge bomb on the blogosphere earlier this week. He posted his 2019 Form 1040. Well, the first 2 pages of it, he gave all the numbers. He didn't actually show the entire return, but he went through the first 2 pages and listed line by line the numbers so that you could see how all the numbers work. This is probably the best way to actually understand and learn taxes, is to go through a return. And so instead of like making up a fake return or using mine, thankfully, we have Physician on Fires. So I am going to, okay, so I went through his blog post, and I will post that in the thread here, but it's easily findable on physicianonfire.com under all blog posts. It's like the second to most recent blog post. All right, so if you've never done your own taxes, even if you've had somebody do your taxes for you, you should actually look through it, have an idea how this all works. Okay, so the beginning, here we go. This is Physician. I think I'm going to use On as his middle name and Fire as his last name. And then I've had the pleasure of meeting his whole family, so I met his better half. They live in northern Michigan now, and they have 2 kids. And then we get to the meat here. And it's important that you include your kids. On one of the drafts of my tax returns for 2019, our second child wasn't on there. And if we didn't have our second child on there, we actually would have missed out on a portion of our, not child tax credit, but the child care credit, the FSA. Okay. Oh, we have an FSA, and then there's an additional child care credit in the taxes. I did that on an episode 3 weeks ago. Okay. So here we go. The first line, which is what most people will fill out, is the wages, salaries, and tips. That is line number 1. How did I get his tax return? Somebody says. He posted it on his blog. Okay. Actually, it would be pretty cool if I could just ask people for their tax returns and then do a show on them. I don't think I would do that. So yeah, he posted it, and I said, yo, Dr. on Fire, do you mind if I do a show about this? And he said, for sure. So, okay, line number 1, $188,000. That was his W-2 income. Now, 2019 was the last year he actually worked as a doctor, and it wasn't an entire year. It was a part of a year. So W-2 was 188. So I guess he was paid as an employee, 188,000. I actually don't know all the details of how he gets paid or how he got paid, because I don't have all the other forms. I just have this form. Some companies will give you, like if the company is an S corp, you could be taking wages as a W-2, but then you can be taking other income on the side separately, and that could go somewhere else, like onto Schedule E, and that all will flow back here to 1040. So the amount he got on W-2 income is $188,000. And actually, this could include his spouse, because when you do married filing jointly, all of your W-2 wages, salaries, tips, etc., all flow through to this individual box. Okay, so there's still some mystery as to what is included in that. Okay, but I think that's basically his anesthesia income on W-2. Now, line 2, this is interest. So this is basically just what interest you're earning on money that is taxable. Okay, and that's line 2B. So he has some money in a high yield savings account, and it paid, let's say, 1%. So let's pretend he had $140,000 in there last year. Oh, sorry, $140,000. That would be $1,400 of taxable interest. Now, line box 2A is tax exempt interest. So, for example, if it was municipal bonds, then that that generates tax exempt interest that would go there. Okay, so then line 3, qualified dividends. So line 3 is dividends, and 3A and 3B, this is confusing because they have qualified dividends and then they have ordinary dividends. So ordinary dividends is like all of your dividends. So those are all your equity stocks that are in a taxable brokerage account. Okay, this is not money that's inside of your 401k or IRA, anything like that, because those are all protected from tax while they are inside there. This is money in the taxable brokerage. Those equities will spit out dividends. And as I mentioned previously, you could have qualified dividends or non-qualified dividends. So both of those combined make up what's called ordinary dividends, which is $50,000. And then the qualified portion are those which he had holdings of, which were more than like 61 days old at the time the dividend paid out. So those were qualified. So of the $50,000 of ordinary dividends, $35,000 of it is qualified dividends, and that gets taxed at the favorable tax rates of 0%, 15%, and 23.8%. Okay, as opposed to the regular ordinary income. Okay, so you could subtract it, and 35,000 from 50,000, you would have 15,000 that would be taxed at ordinary income rates, your regular marginal tax rates. Okay, so line 4 are IRA distributions. So when you're retired, and let's pretend you're just taking money out of an IRA, instead of having wages, which would be in box 1, you could just have money coming out of your IRA, and that would show up in line 4. Now, for all of you who do a backdoor Roth, you have to put in $12,000 for 2 people or $6,000 for 1 person into the traditional IRA, but then you do a Roth conversion. That Roth conversion is an event that distributes a 1099-R, effectively an IRA distribution. So you put $12,000 in, and it gains interest for like a couple days, $2 worth, and so now it's worth $12,002. You do the Roth conversion of the entire amount, and then the $12,000 was the original basis, how much you invested, and the $2 of earnings. That $12,000 that was invested went in post-tax. You don't take a deduction on it, and you don't pay tax on it. So the only amount you pay tax on is the $2 that it earned. So there's that $2 in there on box 4B, so you have to pay tax on that. Now, 4C is pensions and annuities. If you're retired and you have a pension from your job and you're receiving money from that pension, that would show up there. Okay, some of it could be taxable, some of it might not be taxable. So all of these have a taxable amount and the total amount. The same goes for Social Security benefits. So if you're starting to take Social Security, you're age 65 or older, and you're taking Social Security, the amount of Social Security that you're given each year, they will give you a form, a tax form, that will show how much Social Security you received. Now, not all of it is taxable. So yes, FYI, Social Security, even though it came out before, you actually haven't paid tax on that income. That was a tax, but now you're going to pay a tax on that tax, and the amount you pay is based on your income in that year. So you put down the taxable amount. So he doesn't take Social Security yet, so that's also 0. Now, line 6, something that often a lot of people ask me about, this $3,000 loss. Now, he had a bunch of tax losses to harvest this year in 2020, like 6-figure amount. But that was 2020. This is a 2019 return. He had some losses last year and the year before. He also had some gains. He had the beer pub investment, the bar restaurant, I don't know what to call it, sorry. The brewery sale, and he was a minority owner of, and he got some capital gains last year. So let's pretend he got $10,000 in capital gains last year. That doesn't show up here because he had more losses than gains. So he had losses and he had banked up losses. So let's say he had $50,000 of losses he's been carrying forward. If he took 10,000 of gains last year, then 10,000 of those carried forward losses would offset his gains for last year, and that would be a wash. He'd still have 40,000 left. The IRS says you can take $3,000 of those losses, extra losses, and apply them directly here onto your 1040, which is fantastic because this will offset all of your ordinary income, your W-2 wages, business income, etc. Okay, but only $3,000. It would be great if you could use it to offset all of your income. All of those losses, but no, it's limited each year. Okay, then. So the biggest amounts he's had so far are his W-2, $188,000, and his dividends of $50,000. Now, I forgot to mention $50,000 in dividends. That's a lot of money, right? So let's pretend you have $2 million in a taxable account and you earn 2.5% on that per year in dividends. That's $50,000. So that's a lot. So thankfully, most of it is qualified, but he will have to pay ordinary income tax on $15,000. That's a lot of money. That's about as much money as I made my whole first year as a teacher after college. Crazy. So big line 7A. This is his other income. Okay, now other income comes from Schedule 1, line 9. I'm going to go through some of the schedules on other episodes, but this brings in all of his other income from other jobs, other businesses that he's an owner of or a partner in. So he owns, for example, his Physicians on Fire company, but because it's part of the WCI network, there are some shares there that are not his. He doesn't own 100% of it, at least to my understanding. But then there's also like Passive Income MD. His because they're all part of the network, there's some sharing of the shares across partners. So he gets some money from Passive Income MD, the physician philosopher. From their profits get distributed to him as an owner of a portion of those companies. Okay. So all of this together from these companies and maybe others that I don't know about. So this could also include other real estate income, other things, all combined to make $286,000. That is a lot. I mean, that's impressive if that's all coming from these other businesses. That's more than he made as a physician. So granted, when he was working as a physician full time, he made a lot more than $188,000. But with these two combined, that's a lot. That's like a private practice anesthesiologist, making around $500,000. That's pretty impressive. It's very impressive. Now, you put all this together, $523,000 of total income. Now, that includes taking out $3,000 for that loss of capital losses. So it would have been $526,000. Now, at that point, okay, $526,000, I'm going to show a different screen if it will let me do this. Let's just pretend he were earning $526,000. These are I haven't actually published my 2020 graphs. So this is 2020 federal marginal tax and effective tax using the standard deduction. Okay, so this graph right here goes up to $500,000. So on $500,000 of income, assuming you take the standard deduction, that's $116,000. See this green line right here? $116,000 in tax. Now, at 520,000 or so, let's say 525,000 would be this little hash mark right here, and it would be a little bit higher. It would be around 125,000 in tax. Okay, so that's how much he would be paying in tax if he just stopped there and did not have any other things to help offset his income. All right, so I'm going to bring up the return again. Okay, spotlight it. Okay. Now, so instead of paying $120,000 tax, it gets way better. So then he has adjustments in line 8A, adjustments to income from Schedule 1, line 22. Okay, so what is actually in this? I think the box disappeared. Okay, so his adjustments include basically his 401k. So he got about 52,000, not the full 56,000 last year based on like cross-testing. It's confusing. I don't honestly know all the details, but it wasn't quite, but almost. But so that's really impressive, first of all. So if he has $52,000 in there, then probably, sorry, might not have been from cross-testing, might have just been from the total net income of the businesses. So if you make like $285,000 in this year as a solo employee at 1099, you can put the full 57,000, about 1/5 of that. So getting in a little bit less, 52,000. I mean, he made a lot of money in his side business in Physician on Fire last year. So you could, I mean, $286,000 was his total, and probably the vast majority of that, maybe $250,000 plus of it, was Physician on Fire income. So he's basically already maxing out the 415, I think section 415C limit, which is the amount of money that you can include in your income when calculating your retirement account contributions, 20%. It caps off at once you hit that income level, and then any income above that, you can't just keep adding 20% into your 401k. So he got $52,000 into his 401k. Then there's also his HSA contribution that he can deduct here, and then also half of the self-employment tax he pays for his business. So all in all, that was $61,000. This adjustment, okay, we call these adjustments, not deductions, because deductions come later. There's a term that we often use in discussing taxes as above the line deductions, okay, which are the deductions or these adjustments that happen at this point in the tax return, okay? This used to be the bottom of the first page, and you get to what's called your adjusted gross income, which we're getting to next, and that used to be the end of the first page, that line. So anything that was above that line were above the line deductions. Anybody could use this, okay? Any deduction from there can count. I'm going to get to the itemized in a moment. But so he had $61,000 of adjustments and $523,000 of total income. There it is. I couldn't find my box. It's super small. You can't read it. But that $6,200 to the HSA, $3,100 was half of his self-employment tax, and $52,000 to the I-401k. Now I'm actually rounding off all of these numbers. He actually put his actual numbers on his page, but it makes it a lot easier to read seeing just rounded numbers. So the adjusted gross income, the AGI, is that $523,000 of total income. Okay, now that's offset by that $3,000, but we're going to say that's the quote unquote total income. And then $61,000 of adjustments, which is basically mostly the 401k. So that brings the income down to $461,000. This $61,000 of deductions saves him a lot of money in tax. But wait, there's more. Okay, so after that, then you have to choose between taking the standard deduction or itemizing deductions. Okay, and that amount is around $24,000 for 2019, around 25,000 for 2020. Most Americans are taking the standard deduction. We actually are taking the standard deduction for 2019. Okay, because you need to have enough deductions to exceed the standard deduction, or else you just don't bother. Okay, because you get all that for free automatically. So you wouldn't itemize $5,000 of deductions and then put 5,000 of deductions when you can just take 24,000 for free. Okay, so what counts as itemized deductions? Your home mortgage, interest, and then SALT, state and local taxes. So that's state income tax, that's city income tax, that's property tax. But those SALT taxes, state and local taxes, those combined cap out at $10,000. You can also even use sales tax. Okay, but it's very easy to get to $10,000 or more with all those, and it's capped at $10,000. And that's why most people are taking the standard deduction, because if that's capped at $10,000, you would need $14,000 more dollars of deductions to qualify to exceed the standard deduction. The third thing is charitable giving. Okay, and there's a limit on how much you can deduct in a given year. It's 30% of your AGI in terms of cash donations. I think that's right, but it's 30% of AGI. And so the total amount of deductions he is able to take here between property tax, the SALT taxes, $10,000, okay, and charity, $142,000 to charity. It's $152,000 deducted. Okay, so it's $152,000 less taxable income. Now, if he's at the if you're at the 24% bracket at that range, then that's like $37,000 of taxes saved. It's a lot. Okay, now here's the big one. This is gigantic. The qualified business income deduction, the QBI. Now, this is super confusing. It confuses me a lot because I don't qualify for it. If I qualified for it, I would understand a lot better. And it depends if you're a W-2 or 1099, or it's really complicated. But there are there's different calculations you do, and you choose whatever is basically like the lowest one. So when you look at this, you can look at the total QBI, and let's just assume that all of the 7A income, $286,000, is considered qualified business income, QBI. You take 20% of that. Okay, so 1/5 of $286,000. That is, I should have done this, written this down before, but that is $56,000. $56,000, a little bit more than that. Okay, now you also look at your AGI, basically $461,000. You subtract all the itemized deductions of $152,000 and the qualified dividends, and that ends up being $275,000. Okay, you look at that $275,000 and you look at the QBI of $286,000. You pick out which one of these is lower. So the $275,000 is lower. You take 20% of that, and it's $55,000. Okay, that's amazing. So basically, 20% of that income is not taxable. So you're getting a huge tax deduction on all of that income. It's saying like the first 20% of that you don't have to pay any tax on. So of that $286,000, the first $55,000 of it you didn't pay any tax on. That's incredible. Okay, so you add up the qualified business income deduction, the QBI deduction, and the total itemized deduction of $152,000. That's $207,000. Okay, that is not quite, but it's approaching half of the adjusted gross income, right? And remember, we started up here at $523,000. So we start at $523,000. We take off all of this itemized deductions and the adjustments and the QBI, and we end up at the bottom here, $254,000. So $461,000 minus the $207 is $254,000. That's incredible. So basically, cut the taxable income in half. Okay, so now, how much tax is going to get paid? So I'm going to go back. I'm going to turn that off and bring up my graph again. And on the graph, sorry, it takes a second. This graph is for people taking the standard deduction. So we were at $254,000 of taxable income. You have to basically add back in the standard deduction. So we would be at 254 plus 24,000. So we're at like $280,000. So you look over here on 280, and the total federal tax here is around $50,000. Okay. Actually, this is a little bit easier to read. 240 to 260. So right here in the middle, and there you go, or a little less than that. So maybe around 45,000 or so, based on the graph. And this is using 2020 brackets. The tax returns for 2019, so it's going to be close. Won't be exactly the same, but just for comparison. All right. So then I'm going to switch back, and oh, sorry, I didn't even show the graph. There it is, 250,000, and you add back in 254,000, add back in the standard deduction of 24,000, so we're at 280. I'm sorry, 280. So you're over here at like $50,000. Okay, good. So now I'm going to turn that off. I'm going to turn back the other one. I wish I could have multiple things on. You could do that in BeLive, but you can't do it in here. Okay, so we're almost done. So there we go. The total tax on that $254,000 is $46,000. Okay, so the tax bill would have been like $120,000 before without all of these deductions, and it got cut well under half by A, mostly the 401k contribution, B, the charitable contributions, 6 figures of charitable contributions, and then C, the QBI. I mean, these are gigantic. Okay, so then $46,000 in tax. Then you get your credits. Okay, so you basically line 12A says you should be paying $46,000, but then there are certain things you get credit for already, so those tax dollars don't have to be paid again. So they look at childcare and having children. So the child tax credit is $2,000 per person, okay, and per child, but this also phases out based on your income. But because he got his income low enough, now he didn't get it down all the way below all the thresholds, but he got it at least into the phase-out range. So he didn't get $4,000 of a tax credit, but he got $1,000 of a tax credit. Okay, that's equivalent to like the tax deduction of maybe like $5,000 if you're paying 20% tax. Okay, but he's paying less than 46,000 over, about 20%. Okay, so that tax credit is a dollar for dollar deduction on the amount of tax you pay. So $1,000 child tax credit, and then there's the foreign tax credit. So any taxes you pay on international investments can be included as a separate credit. So the foreign tax credit. So here's $1,500. You add those two credits together, that's $2,500 that the total tax bill gets reduced. Okay, so it goes from $46,000 down to $43,500. Okay, so that's basically the federal income tax. But then you have to correct some things. So there's Social Security, okay, so and Medicare. If you work like 5 different jobs, they're all collecting Social Security from you. Okay, but there's a cap on how much Social Security one person can pay. Okay, there's also on Medicare, there's 2 different brackets. There's 1.45% and there's 2.35%. But no one job knows where you are on those brackets because they don't have the other income. So you have to basically correct for all of these things. So it puts in all the Social Security care that you've already been putting in from your job and that's been withheld from you. Okay, and then it also adds in one more tax called the NIIT, the Net Investment Income Tax. I think Okay, that's what it stands for. And that's another 3.8% on certain dollars. Okay, so if you're earning money and you're paying capital gains tax, that's why I always say 23.8%, because the highest long-term capital gains tax bracket is 20%. But then you add another 3.8%. So it's 23.8%. That 3.8% is the NIIT. So he paid some NIIT tax of $2,000, but most of this is self-employment tax, $7,000. Okay, from the business and otherwise, and that has to be corrected for. So those get added on, and that's $11,000. Now you could actually have over contributed into these, and then it would be a negative number. Okay, but here it was a deficit, so it had to be added on, and there's the total tax, $54,500. So his total taxes for the year, $54,500, and his total income, if we exclude this $3,000 of the capital loss deduction, was really $526,000. So that's pretty good. $526,000 and $54,000 in tax paid, just over 10%, about 10.5% effective tax rate if you use 526,000 as the denominator. Now, a lot of that is because of the charitable contributions, right? So if he didn't donate all that money to charity, he'd be paying more tax, and he'd have a lot more money in his pocket, because those charitable deductions did not. He still had to pay that money. He only got a deduction for a small percentage of it, right? But $54,500, that's pretty nice. I can't imagine. I wonder when our taxes will be $55,000 in a year. We pay that much tax in a very short amount of time. It's sad, but also good because our income is good. So, all right. So let me see if anybody's in here. Okay. So that is episode number 83. That is the Form 1040. And it's very important that you understand the Form 1040, because we're going to break it down to other things. I answer a lot of questions relating to tax and all points to the 1040. Lastly, at the bottom of this, they ask you to put in how much tax you've already paid for the year. And if you paid more than $54,500, he'll be getting money back, or he could just prepay 2020 taxes. And if he paid less than $54,500, he'd have to pay that money, that difference. So when you owe money on your taxes, it's just because of the difference between what your tax liability is and how much tax you've already prepaid in the prior year. Okay, that's it. And my sponsor is the Medicine, Marriage, and Money podcast, episode number 3 with Dr. Tiffany Moon, coming at you on Monday. Subscribe, and also please check out our YouTube channel, 39.6 on YouTube. Please subscribe over there. Have a good one.